Ever wondered how companies go from garage startups to stock market superstars? Welcome to the world of IPOs, where private dreams meet public money. Let's decode the IPO magic for you. But you may ask, what exactly is an IPO? So an IPO, or initial public offering, is when a private company sells its shares to the public for the first time. Think of it as a debut party, but for the stocks. From Apple to Amazon, every public company started with an IPO. It's how business raise capital and invite you to own a piece of their success. Now you may ask, what and how does an IPO work? So before going public, a company is owned by founders, family, and maybe a few early employees. Their shares are not traded, they're just paper promise. So private shares equals to hard to value and public share equals to market price. So to go public, the company hires an investment bank, then the bank sets the share price, the IPO date, and handles all the paperwork. Once approved by the SEC and stock exchange, the company is listed and then it is ready to trade. Not all IPOs make the headlines. Some quietly enter the market, while others like Meta or Google arrive with fireworks. Now, fame equals to high demand plus high security. Famous companies attract attention but also face intense pressure from investors and regulator. Now, can you buy an IPO, you may ask? So here's the twist. IPOs are not always easy to buy. The first share goes to big banks and then the institution. Now, primary distribution equals to institutions first, retail investors later. Now, retail investors usually get the access after the lockup period when insiders can finally sell their shares. Now, is buying an IPO a good idea, you may ask? So, buying an IPO can be a jackpot if the company grows. Imagine getting in on Apple or a Netflix early. Now, high upside potential versus overvaluation risk. But beware, not all the IPOs sold. Some crash and burn if overvalued or mismanaged. Now, how to buy an IPO, you may ask? Step 1. Open a brokerage account. Step 2. Meet the eligibility criteria. Step 3. Request shares. Now, brokerage account is equals to eligibility request, then the shares, and then the order will be placed. Even then, the access is not guaranteed. Yes, that's a catch. Brokers have limited shares and prioritize the top clients. Do IPOs always make profit? That's another question. No, IPOs can lose value too. You have to note about it. If the hype does not match the reality, investors lose the money. So this is something that you need to be watchful for. IPO is also not equal to guaranteed profit. That's why legendary investor Benjamin Graham warned the IPOs are not for the faint-hearted. IPOs are exciting but risky. So do your homework. If you believe in a company's future, buying early can be rewarding. And in fact, research first, then talk about the long-term wins, write it down, and then make a proper decision. So next time you get to know about any IPO, don't just nod, dive in, decode it, and maybe even invest. Because in the stock market, knowledge is your best currency. With that, it's a wrap. For more such updates, keep watching moneycontrol.com and please like, share, and subscribe to Moneycontrol's YouTube channel.